It's covering you. What do you think borrowing cost is? Mudir. Assalamu alaikum.
عليكم السلام ورحمة الله وبركاته.
كله تمام إن شاء الله.
100
200% ولا 100%؟
لا 100%.
100%. Okay. What do you think borrowing cost is?
The expense for the borrowing.
Expense for the borrowing. Any other interpretation?
Guidance.
Guidance?
Guidance of measuring borrowing.
No. Borrowing cost. So cost, when you say cost, it is nothing to do with guidance, I guess, right?
Additional margin.
Basically, now forget the cost. What is borrowing? One example is no. So when you borrow funds from, now who generally give you loan? Bank.
Financial institution.
Yeah, bank, financial institutions. They give you loan, and they are very helpful-minded people. They want you to grow your business, so helping you and giving you loan. What is their main business actually?
Lending money.
Lending money. Giving loan is their business. So what is the income they have on this? Interest. So when the bank is lending you money and they're charging you interest, and we had to pay interest for the purpose of borrowing the loan. Correct? So therefore, the meaning of the term borrowing cost are related to this. But it is not only this, but mostly this is the scenario. Now let's say I had to sign up an agreement or contract with the bank to secure a loan. So at the time of signing up, there could be other type of expenses. We may also have stamp duty. We may also have documentation charges.
Management expense.
Management expense, any business will have management expense, but can we relate that to borrowing is the question. You cannot relate the management expense to borrowing. So what I am specifically looking at, what are the costs that we will incur when we happen to borrow funds. So normally the basket of borrowing cost will include interest. Sometimes we use another term, finance cost. On Islamic perspective, that is profit, faida. So, yeah, revaluation. No, that is, yeah. Then the cost that you had to pay for the team who are doing the revaluation. Yeah. So that is included in documentation charges based on what the bank expecting you to set your properties, and all of this will include as part of your borrowing cost. Clear? What is our normal understanding? If I have interest or if I have finance cost, when we produce our financial statement, how I present the interest, where I am showing this? In the profit and loss account, and also if you are following IFRS, according to IAS 1, presentation of financial statement, when I prepare my statement of P&L, I will have a one line item in the statement of profit and loss account to deal with finance cost. Sometimes we can also say interest. Very fine. Now, standard is talking about, this particular standard is talking about, now, when we think about projects, the projects are substantial, huge in size, large in value. So the loan that you're gonna receive for these projects will be very substantial, and the amount of interest that you're going to incur will also accordingly will be very big. Suppose 100 million loan, 2% interest. It is not 2, actually here is 7 or 8, I think now. 6.2. Now, okay, let me make it 5% to make our life easy. So annual my interest will be 5 million. And if I generate profit before interest 10 million, and if I to subtract this, the profit, ignoring the tax, will not worry about the tax now. If I say profit for the year 5 million, this 5 million is only available for distribution to the shareholders. And this, suppose here you have 4 million here, then what will happen? I will have a loss of 1 million. So standard try to see the justification of this, and then the standard has given a chance to capitalize any interest that is there for such significant projects. So what I am saying is, normally, as we all said, interest should be written off to profit and loss account. That's very clear. But if I having a scenario where I have huge loans, maybe one company may not have one loan, maybe have 3 loans, 4 loans, 5 loans. Every single entity, you will end up having loans. So, and then agreed interest rate, it depends, 5%, 8%, 7%, whatever it is. Annual interest, if it is 5% and my loan is 100 million, and I will end up having an annual interest of 5 million. Normal theory, what? Dump all this interest into this profit and loss account. And if your profit before interest, now this line here actually PBIT. Hope you know the full form. Profit before interest and tax. And if that is 4 million, and I am charging 5 million here, and I will end up having a loss of 1 million. Now the question is it justified? Is it fair? Then the standard went on to develop, IASB went on to develop a new standard, actually not new, relatively new, borrowing cost. But they say there, you could capitalize any of these finance costs falls under the heading of borrowing cost. For whom? For that such project. Standard comes up with a special term here. They use a term qualifying assets. Standard use a term named qualifying assets, meaning he has gone and done the ACCA and then became qualified ACCA asset? What is qualifying asset?